The pandemic has spurred an increase in business startups by many attempting to generate new income with new methods, which raises an important tax question when beginning a business. What expenses are deductible? Roger McEowen with the Washburn School of Law joins us now with some guidance in today's Rural Money segment. Roger, thanks for being with us. Now, what are some of the basic principles when it comes to startup costs?
Good to be with you, Tammy. I think the most basic principle is that they're generally not deductible, but there is an election that a taxpayer can make to deduct what are defined as startup expenses for the business on the return for the year in which the business begins. So that's kind of loaded there. You have to know when the business begins, and you have to figure out what your startup expenses are. And that's an irrevocable election. And that's going to get you a little bit of a deduction. It's the lesser of the amount of the startup expenses for the business, or $5,000. So not a whole lot, but it is something.
Can you be specific about what startup expenses actually are?
Well, those are amounts that you would pay or incur for investigating, let's say, the creation or acquisition of an active trader business, or creating the business itself, or anything you do to engage in for profit and the production of income before the date on which your business actually begins. So it's the expenses you incur in anticipation of becoming an active business.
And so how does one actually figure out, because I know you do a lot of legwork when opening up a business and a lot of research, and so when do you determine when the business actually begins?
That's a great question. That's kind of the key to all of this. And unfortunately, there aren't any regulations from the Treasury that help us define when a trader business begins. So it's basically answered on the facts, based on the facts and circumstances of a particular situation. You've got to be undertaking the activity, intending to make a profit, be regularly involved in it and actively involved in it, and actually commence business operations. So it's pretty broad definition, but those are the confines.
Any big takeaway from this?
Well, actually, we did have a big case out of the tax court last week on this. It involved a farming operation. A lady was trying to start a farming operation, and she and her husband were residents of California, but she had 6,500 acres down in Mexico, and she reported a net farm loss for every year for about 8 years in a row. And she started raising chickens. That didn't work. Switched to livestock. That didn't work. Tried vegetables. That didn't work. Tried raising eggs again. Got destroyed by wild dogs, on and on and on it went. And she tried to deduct all of these so-called startup expenses, and the court said, look, no, you tried to do all these things, and you were shifting from one thing to another, plus growing peppers. You sold some eggs, sold some cows, but you never really got beyond just preparatory expense. So it's a great case on showing us where the line is. And unfortunately for her, she never crossed the line, and those expenses were not deductible.
All right, she had to kind of learn the hard way, as they say. That's Roger McEowen with the Washburn School of Law. Appreciate that information today.